The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks, and Happy New Year to everyone. Well, we started the new year with probably one of the more startling things in the financial markets. That comes from Germany, where the 5-year note is now negative interest rate. In other words, if you buy a note, they're not only going to give you any interest, they're going to charge you for owning it. Such a deal. Anyway, this is earth-shaking. We never had this before, so they keep dropping interest rates. We've had a huge run in our Treasury bond market here in these last 24 to 36 hours. We've rallied about 3 full points in bonds. The chart that I posted into Tiger TV shows the inversion that we're having with the Treasury bonds versus the Treasury notes. As you can see, the short-term rates, the 5-year and 10-year notes are not making new highs like we are with the 30-year Treasury bond. That means that the yield curve is flattening. Folks, a flattening yield curve is about as negative for stocks as you can possibly get. So whether this is the big turn down that I've been looking for or not, we'll have to wait and see. But we're already off about 60 points from the high in just a few days. But what's more amazing than that is at the time of the year that it's doing it, because the last few days of the month, the last 3 trading days of the month, and the first 3 trading days of the month are usually the most positive days of the year. And that is certainly, the most popular days for a bullish sign during the month, not for the year, of course. January is usually a good sign, the first 5 days of January, but here again, that is also predicated on a shorter term cycle that we look at. Last year, if you remember, the stocks broke into new high ground, I believe in early January, and then had a vicious break into February 4th, and then proceeded to rally the whole year. And we're going to know if this sell-off is going to mean something. The numbers that Basil just talked about as support in the S&P is pretty much spot on, around 2015 in the S&P. That's the 61% retracement on the futures. We got down to 2017 so far today, but it's still rather early. Since we're starting out the new year, basically, folks, I want to put the chart of the New York Stock Exchange Index into the room and let you really see what stocks are really doing. Since July, we've been making lower highs. We've had a strong divergence between the New York Stock Exchange Index and the Dow Jones Industrial Average. You can see it very, very clearly by these downsloping trend lines that we have marked as green. The blue line is the Dow Jones Industrial Average, and as you can see, it's gone substantially higher than where it was in July and also in September, but we've not done that with the overall stock market. And remember, the Dow Jones and the S&P and the Nasdaq, which are roughly 530 stocks, because you have a multiple counting, because some of the stocks in the Nasdaq are also in the S&P, you have roughly 530 stocks that are controlling, what these indices are doing. And the other thousands of stocks that are out there are not showing the same thing. When you add to this the fact that the advanced decline line, the number of new issues versus, not new issues, but the number of declining issues versus the number of rising issues has been increasing. In other words, there's more stocks making new lows than there are stocks making new highs. That's telling us that the breadth of the market is not in very good condition. In addition, if we add to that margin debt topped last month, it's come off a bit, but it's still near record levels. We had the same thing happen with the bullish consensus. It's backed off a little bit, but still near record levels. And on this last run, all these records were broken. We took the highs of 1929 out, the highs of 1974, the highs of 1995, 2000, 2007. All those records were broken, which should be the case because this has been a tremendous bull market that started on March the 9th of 2009. So we're going to wait and see, what happens. Basil talked about the VIX index. We rallied strongly off the 786. It's held that level quite nicely. We should bring that up and let you folks take a look at it because it was able to hold pretty nicely at the spot that we were looking at around 14, and now I believe we're up near the 20 level as I recall, and so we want to keep thinking that this is going to move. But we have a really good, interesting place for the market to hold, and that's at that 2015 in the S&P. That's down 70 points, and what's so surprising is it's down 70 points very, very quickly, and that's the main thing that we're looking at. We have a question from one of our people in the den, and that is about the price of the euro. And I believe that the euro is heading towards, we've been saying this for a very long time, close to the 112, 110 level in the euro. We've had a great deal of movement today, but you'll notice that if you take a look at this on the long-term weekly chart, you'll notice that the euro has oh dear, just one second here. I've got to change just a tiny little bit here. There we go. Then we can do it. I've posted in the long-term weekly in the euro that goes back about 25 years, so you'll be able to see, what's really happened. The euro really didn't come into existence in '99, so that's pretty much the Deutschmark chart that you're looking at with this euro versus the U.S. dollar. The euro came into existence around '99. It first began trading, I believe, late '99 or early 2000. The reason why I remember that is my grandson was born on August 14th of 2000, and for his birthday, inauguration birthday, we got him all of the euro coins of all the different countries in mint condition. And we put those into a little collection for him because someday I think those will be worth quite a bit, especially if the euro, goes the way of some of these other currencies that came out that didn't do very well. But we went from 82 back in 2000, that was around August when he was born, and we doubled in price. I got up to the 169 level, almost doubling in price. And since the last 6 years, we're in the 7th year right now, we're coming down to the 61% retracement in the euro that comes in around the 113 level. We're not very far away. We had a lot of movement last night. That was primarily related Sunday when the things opened. They opened relatively quietly, and then just the whole world just wanted to sell the euro and the pound and the Australian dollar, and everything broke very, very rapidly. But what was so interesting with the markets is the market that the dollar move, the dollar cross rate that has been the strongest of all, has been the Japanese yen, and that was the one that didn't even budge. It couldn't even take out the highs of the previous day. And since that's happened, it's backed off over 100 pips. So that would have been the one that you would have been watching to sell because you had the lower highs, and that's the one that looks the most interesting. I want to put that in here to show you just what it looked like with the rest of the world, going crazy, wanting to buy the dollar. The one that's been the strongest, which was the yen, didn't move very much at all. In fact, it made lower highs. It had 3 lower highs going back over the past 3.5 weeks. So that was telling you that it didn't have the same strength that the others did versus the dollar. So I think that's an important thing to look at. Another question that's just popped up is, what is happening, with the price of crude oil? We've been watching this for a very, very long time, and we're very, very close to where we should be coming in. We're just a tiny bit below that right now. The ratios have not held. 61, 50%, 38%. None of them have held, and right now we're already below the 786 retracement in the crude oil that came in at around $51 a barrel. We're trading about a dollar a barrel lower than that right now. So that's telling us that the 786 is not holding either. We're having the same thing happening with gasoline futures. They're breaking down. I mean, we got gasoline futures at near the 138 level. We're going to be approaching gas at under $2 a gallon here pretty soon in some parts of the world, some parts of the country here, and that's going to be a very, very interesting phenomenon, because we have just recently, as just back in July, we were looking at, gas at around $4 a gallon, and now we're looking at gas almost half that price. So that's a really nice spot. In fact, someone just mentioned that in Tampa, Florida, the price of gas is already under $2 a gallon. So you can buy gas for $1.95. I guess you should drive down there and buy some. We'll have to wait and see. Oh my gosh, boys and girls. Mr. Roberts has some really special for you for the new year. You'll never guess who's calling in for us. It's Priceline Charlie, probably from La Paz, Mexico. Charlie, are you there?
Yes, I'm there. How are you, Larry? Happy New Year.
Happy New Year to you, my friend. Everybody in the family was thinking about you all during the holidays, because we knew you were still short the price line, and we were kept waiting for some type of a gift from you, like a case of champagne or a box of chocolates, but we figured you were too busy, so not a problem.
I did crack a bottle of champagne open.
Good for you.
I was waiting for everybody to come here. You got to come to Mexico. It's nice and warm here.
We used to go down there a lot. We used to go down to Cabo San Lucas, and also to Rocky Point quite a bit. But in the last few years, we just travel so much that we really don't get a chance to go down to it. But I do like parts of the Mexican mountains back where the silver mines are. And that's really a beautiful area, and I like that very, very much. That's like old Mexico, and that's a lot of fun. But where you are is pretty much heaven down there, my friend, so don't do any complaining, okay?
No, I'm not, but I tell you, I flew into Oklahoma City to look over a crane for a customer, and the price of gas I was paying was $1.69 to $1.79 a gallon. I couldn't believe it.
Wow.
Yeah, when I hopped back into Texas through Dallas, the price in Texas was like $1.91. And I'm like, wow. That means Texas is going to have a recession. That's the way I look at it.
Not when they got the potential future president down there. They're not going to let that happen. This guy's going to run for president, and they're not going to let that happen. That state's been run the best of all the 50 states. And so I don't think too much. Charlie, I know less about politics than I do about the market. So we should end it on that note, okay?
Okay, I agree.
What can I do for you, my friend?
I was looking at Priceline, and the last bounce was to 1170, and I was wondering where support would be on a 0.5 Fibonacci retracement. And what would be at 6.618?
Okay, I'll tell you what we're going to do here. I'm trying to get the clarity of this Skype working really good for us. And so what I'm going to do is we're going to come up to a break here. We've got to pay some bills for Tom, okay. And this is it. You stay with us, and we'll look at this chart when you get back, okay?
Okay, very good.
You bet. The Dow's down a couple hundred, and oil's down $2 a barrel.
How would you feel if you had a powerful decision-making tool that has the ability to find high-probability trading opportunities across multiple time frames in equities, currencies, and futures? Search no more. Take advantage of the best trade with the TAS Profile Scanner. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to help them make the best and most accurate decisions. Scan over 1,000 equities, currencies, and futures instruments for high-probability trading setups utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time, for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. Subscribers will also gain access to the December 9th workshop with John Logan. There's no obligation to pay anything. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, and we still have Charlie on the line. Priceline Charlie, you still there?
I'm still there, and I'm still watching the chart.
Okay, I posted the chart into Tiger TV for Priceline, and it looks to me we're going to drop about another $20, the minimum, down to the 1090 level. That's where the 61% retracement comes in. But Charlie, with this really wide bar that we're having today, down $28, that usually means that the market could extend down. And remember that our target on this, on the longer-term Priceline chart, goes down to the 926 level. So we could drop another $200 in Priceline and still just be doing a normal correction. So if this were my position, and I'm sure you'd send it over to me if it was, I would just put a stop at your area where you were looking at. You were in around 1170, so put your stop at around 1150 to lock in some profits and let her rip, because it could easily drop $200 from here without any trouble at all.
Oh,
especially
okay.
if the market would turn bearish.
Oh, okay. I actually added to my shorts on Friday.
That didn't surprise me at all. I was expecting you to do that.
And because we were right at the 50-day moving average, simple moving average 50-day, I shorted, and that it went back today further down. That's a good sign. So are you thinking? Watch the 1090 level.
Well, actually, 1090 level would be the first level to look at. If it takes several days to get there, then I would start to lighten up the short side. But if it gets there in a couple of days, like tomorrow or the next day, then you know you've got something really powerful moving, and we could easily make it down to that 926 per share level, because that's several big A, B, C, D levels that come in there on the long-term chart for Priceline, and that's the one that I would be looking at. We're certainly in a downtrend. We've made lower highs, ever since July, so that's what it looks like to me.
The last support was just above the 1,040 level.
Correct.
Would that play a part in this coming?
Yes, that's where I come up with the 1090 per share level. Basically, you go from the low at 1042 up to the high we made at 1170, and 61% of that comes in at 1091 per share. So that's where that comes in at. So going below that, that's important. But the key here, from a technical standpoint, Charlie, is the fact that we're down $28 today, which makes it a very strong long bar to the downside. That's a lot of selling. There's not a lot of people willing to step in and buy Priceline around here. So that tells us that we are looking like we could go lower. And if we get below the the 1090 level, the next level with any support at all comes in at 926. So I think it's worth your effort to watch it at that levels.
Good. Thank you very much for the explanation. I really appreciate that.
And always love to hear from you, and Happy New Year, and keep enjoying Mexico. When will you be coming back to the States? Sometime in the spring?
Yes. I'm thinking more like the summer, maybe around June.
Okay. Well, be safe down there, and Happy New Year to you, Charlie.
Same to you. Take care, Larry. Thank you. Bye.
You bet. Okay, that was our friend from La Paz, Mexico. He travels all over the place, and he's in the stock of Priceline, which has been making lower highs since last February. So it's been a much weaker than market stock, which tells us, pretty much, where we are at that point. Now, we've had a question from one of our favorite folks. You're all favorites, but some of you have donated so much of their time with TFNN, which is Mr. Z, has done quite a bit. He asked us about the Canadian dollar, and we had a chance here on the Canadian dollar, but with last night's action, with the big move that we had getting above the 118.60 level, you'd pretty much have to stand aside on the short side of the Canadian dollar. Now, I would like to bring up what we're looking at here for just 1 second, and that is to take a look at the U.S. dollar index, because this happened last night that we were watching, and I wanted to show you. This was done by my good friend and partner, Jim Bartolioni. This is a chart that goes back, well over 15 years, and what we're doing now is we're making a 38% retracement on the U.S. dollar, and it's also two ABCD patterns. These are on the long-term weekly charts, folks, so this is a very, very important chart. Whether this is going to be the end of the move or not, I don't know. It's just that we hit that number exactly last night when everything was going crazy. So, okay, we're going to take a little break here. We got stocks down a couple hundred points, and we've got the crude oil down $2 a barrel. We'll be back after this message.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks. And we've had a question about the gold market. Friday was a very interesting day in gold. We went down and took out the previous week's low by about $1. Which happened to be right at the 61% retracement at $1,169 an ounce. We've now rallied $40 an ounce. We're approaching the 1205 level. We really need to get this market above 1240 in order to get it moving, but it could have a move at least to the 1292 level, about $100 from where we are right now if it starts to move. We've had a really nice bottom there. The bottom that we're seeing is a 135 rising bottoms. This was a pattern that was used by Roy Longstreet, one of the greatest soybean traders that ever lived. I happen to know he and his son, and they really love this pattern. And when they happened to look at the 786 and 61% retracements to see how they formed on the 135, they got very excited about this pattern because it forces you to trade with the trend. And that's always a good thing because the trend is your friend, as they say in the trade. But gold still looks positive from this level. They've really tried to beat it up, but they have not been able to, and so it held up relatively well. We had the same thing getting ready to happen in the silver that we talked about many times, and we've got silver now trading above $16.07 an ounce, which is a pretty good thing, but silver's still lagging behind gold, quite a bit. It's still far, far below where it should be relative to where the price of gold is right now. I still think gold has a chance, folks. I'm one of the few people that believe that all this shenanigans that's been going on with QE 1, 2, and 3, and 4, and 5, or 12, whatever they're into now, is going to come back and bite somebody on the keister. And that's not what economics is all about, folks. What the Fed has tried to do is to alter the business cycle, and it's not nice to fool Mother Nature. And I think it's going to come back and haunt us quite a bit. I've started the show talking about the German interest rates being negative on the notes, and that's a very important fact, to look at, because all the people are trying to raise money in order to, pay their debts and things like that. And it's nice when interest rates are low. But as interest rates start to move higher, then you're looking at something, altogether different. So that's the key to, what we're watching here when we're, trying to look at some of these things. We're having a huge move in bonds these last few days. We got up to that 147 and change level. That's near the long-term 786 retracement at the 148 level. Remember, bonds hit 154 was their high about 2.5 years ago. And we could easily go back and hit that, because if the market starts to trend and we have a flight to quality due to sell-off in stocks, with Dow down over 300 points, that's telling us that we're looking at something pretty dramatic here. Now, we do have the full moon today, and so we'll keep an eye on that phenomenon if it does, but it hasn't turned anything as of yet. But you don't know, it might not turn till tomorrow. It could be a day or two off. In fact, it's the case, but we've been down ever since the 30th of December. So we're in a 5-day correction, and that's usually all you get, 5 to 7 days max in a bull market. And there's no other way to call this thing in the bull market. It is flat out a bull market. There's no question about it, in my opinion anyway. So we'll wait and see if there's going to be a rally here. But the quality of this rally is really going to really mean a lot to me, folks. That's really what I'm looking at. I think it's really quite important. One of the other things that we talked about, we were talking about margin debt and the number of bulls and bears, and the advanced decline line, what it looks like, new highs to new lows, the divergence that we're seeing in the New York Stock Exchange Index. It's historical. We've never seen anything like that before. And so all these things are coming together. But the main thing is the long-term patterns that we look at on the weekly and monthly basis. There's still this 1, 2, 3, 4, 5 expanding triangle, also known as reverse point wave. That pattern is still intact, and we've had some pretty big moves. But in fact, many of them have still not violated those levels that we're looking at. Now, one of the markets that you really need to pay attention to during this time is the junk bond market. You don't have to trade it, but just pay attention to it, because you'll notice that the price of the 30-year Treasury bonds have been going straight up, and we've had a huge break in the junk bonds. And so the yield on the junk bonds is still high compared to the 30-year bond, but it's starting to widen even more, telling you that people are taking a flight to safety away from junk bonds, because junk bonds are, i.e., high-yielding bonds. They were called junk bonds for many, many years until Milken, gave them the name of high-yield bonds, and that's when the whole, process started. Now, there's something going on with junk bonds. I don't fully understand it, but it's related to the oil market, that many of these companies that have worked with the oil business are using these junk bonds for their financing, and now these things are collapsing right under them. They're just basically it's like a house of cards, and that's pretty much what's happening. Oh, we've got one of our favorite folks from Florida calling in, Dr. Scott. How are you today?
Hey, Larry, can you do me a favor and put that daily silver chart back on there so I can ask you some pattern questions?
You bet. Just 1 second. It's the same price, so stay with me, okay?
All righty.
Is gas really that cheap down there in Florida?
No, I was just talking to the screener. It's a little over $2, which is better than being a little bit over $3, but it's about $2.19 here, which is I'm not complaining.
Well,
okay, Larry, on this chart here, I was going to ask you about gold, but then when I was thinking about gold, you put silver up, so I'll ask you about silver. You're talking, on gold, you were talking about kind of an ABC type of pattern, getting over pivots. That's how I would interpret it. But on this chart, you have a head and shoulders diagram there. And I always have trouble with head and shoulders, especially when I'm going to use the word like Gartley would use it, the armpit is where it is on this chart. It's not, you really have, it's a low yield head and shoulders to me because, first of all, because it's less than a 3/8 retracement from that C point, the swing down. But it's also that head and shoulders. It's not, you're not breaking through higher, a lower high, a level of sellers.
Right. It doesn't have the symmetry. That doesn't have the symmetry that you'd like to see.
Yeah, I mean, to me, that is a high-risk trade to go long there.
Mm-hmm. Well, they're all high risk anymore because of the volatility that we're having, but you certainly knew where you were as far as your stop protection. What was interesting here is that when the right shoulder was being made on Friday, the gold made the 61% retracement, but silver could only make a 50% retracement. So silver was acting a little bit stronger than gold on Friday, so that could have been one of the reasons why it's had such a strong move here. Today it was telegraphing that there was more buying coming into silver than there was to gold, if that's the case, but that's what has in fact happened.
And Larry, it's this pattern of a head and shoulders that I would like to ask you about. And if you go back on the same chart, and it's over November, you have a C there, on your Pesavento indicator there. The C.
Sure, I see it. Yes.
And then, and I'm not saying that it's a perfect head and shoulders or anything, but then the market goes lower, so that would be at an A point around January. Then it goes higher to a D, and so the D is not above the C, but let's pretend that it is. And then it goes down to January, where the low at January is breaching the low in December.
Mm-hmm.
And so it's not really a head and shoulders in that, the head's not above the shoulders, but it's that break of the base.
Mm-hmm.
And to me, sellers at least taking out a level of buyers, that if you can see that on a head and shoulders, it gives you a much higher yield on a head and shoulders. And it's just not even close to that. And the reason why I bring this up, I've lost so much money trying to trade head and shoulders over the years. Mm-hmm. And it dawned on me that it's in that structure that's missing, that makes some head and shoulders better than others. And to me, it's a bad head and shoulders because I lose money on those. Does that make sense? You and I have talked about it in the past, but I don't know. I think head and shoulders can be a very expensive trade.
Absolutely.
If you're not careful.
One of the things that you might help is to measure the distance between the shoulder and the head and the shoulder. And if you have symmetry there, that really, really helps. In other words, have symmetry, which would be cycles. In other words, 14 days from the shoulder to the head, and then another 14 days from the head to the shoulder, whatever it is, 18, 14 days, 22 days. But if you have that, and you add the ratios to it, then it would have the symmetry that's really necessary. One other thing, Scott, that's very important that I've tried to, drive this home to you is don't take the losing trades.
Yeah, you keep on telling me that. I don't know what I'm doing wrong here, Larry. I need to listen better.
Yeah, well, we never know which ones are going to win, but the timing of the head and shoulders is difficult. So watch the distance between the shoulder and the head and the shoulder in time, and that adds symmetry to it. That reduces your risk down because, if you're down at a 618 and you're 14 days from the bottom like you were on the other side, then that really gives you some really nice symmetry to work from. This is what we had in silver. The problem with the silver is it didn't come down to the 61% retracement. It missed it by about 30 cents, which is $1,500 in silver, and that's a lot. Now, gold hit it spot on, but silver was stronger.
Okay.
Okay?
Well, I appreciate your going through
Well, we
this.
appreciate you calling in.
Okay, we'll talk later. Thanks.
Thanks a lot, Scott. Happy New Year to you, my friend.
To you as well.
Okay, we got a caller from Florida again. Seems to be a Florida day. Jim, are you there?
Yes, I am, Larry. Happy New Year.
Happy New Year to you, my friend. What can I do for you?
I got a question for you, but for all the readers, they may know about it. There's a site called GasBuddy.com. You can put GasBuddy.com, Oklahoma, and I'm looking. I just can't believe it. $1.55 a gallon cash at Oklahoma City. $1.58, $1.59, $1.59 with a credit card. Updated.
May I ask you a question, Jim?
Yep.
How many people in Florida would like to live in Oklahoma?
Well, it's 211, 215 here, so but it's just pretty shocking, and I guess
it's hurt a lot of people in the oil business for sure. It's been a really disaster, for the oil business. But and it's not over yet. It's not over yet. So what can I help you with, my friend?
Well, what I want to do is have you pull up that E-mini. I got lucky. I shorted it on Friday after that day. I shorted it 2053.
Oh, that's a good one.
We had the blip down. I covered it at 2043 this morning, but then I looked at the weakness and reshorted at 2041. I only have one contract, but I really, I've got I keep rolling my stop down. My buy stop right now it's at 2028, and I'm looking at the 0.618 retracement at 2010, so that should be support.
It should be support. I'd watch that very, very quickly. Now, we're down 7 days from the high that we made on the 29th, so we are going to get a bounce here somewhere because for several reasons. One, it's the time of the year when people usually start buying because of the January effect. This is the last few days for it. We have the full moon coming in also, so just be careful. Keep rolling your stop down, and I think you're going to get a chance to sell it on a rally. I don't think it's going to go straight down from here, but it went straight up, so anything is anything is possible.
I mean, 7-8 points, is that too close? I mean, because on the other hand, we break support. We start running. We break that 2,000. We're going to run to 1960 real quick, and I really don't want to give away $3,000 or $4,000. This is probably
you've got to put it someplace. You've got to pick a spot, and I think 2028, that's up 10 points. Dow's going to have to rally 100 points just to get close to that number. So I think that's a good number to look at, and just let it go to see what happens. And when it gets to 2010. Take a look at it, and if it looks like it's staying there for half an hour, you could, buy it back, and if it starts to break it again, do what you did today, resell it,
Hey, before the break, I got to tell you a quick poker story. I'm playing on Saturday. They're only paying 13 people. There's 18 people left. I'm running down with the blinds, and the blinds are already 5 and 10,000, and I'm stuck at the big blind, and I'm looking down with a 3-7 offsuit, and 4 people limp in, and so the flop comes 4, 5, 6, and I go, I will never say one time anymore in my life, and I flop the straight. Guy next to me, I check the straight. The guy next to me, he has pocket aces and raises to 60,000. Everybody folds, so I've got my luck going for the year. When you flop the straight, George stacked it at the one away from the final table.
Well, that's what happens to be. Do you find to make you make it into the money?
Actually made it in the money. Got knocked out 9. Got 9.
Well, that's good.
Most patience I've ever had. So I want to apply that to the market this year.
That's what you need to do, my friend.
Have a great one.
You bet. Happy New Year to you. Yes. Bye-bye.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Darrell Martin here on TFNN.
Okay, we're back, folks, and we've got a caller from the neighboring state of New Jersey. Rob, are you there?
Hey, Larry, how you doing?
I'm good. Happy holidays to you, my friend.
Happy holidays. Great show. Hey, I have a question about the Australian dollar USD currency. Do you think it looks like it's going to start moving back up for a couple months, like a big change, or
I will tell you this: we've broken below that 1.618 level in the Australian dollar, which I thought was going to hold. It broke through there Friday, which told us we were under a little bit of a problem. But if we take a look on the really long-term Australian dollar, which I really like, I just came from Australia where we had four speeches over 9 days, and it was really good. But we've got a fabulous pattern coming here in the Australian dollar, in my opinion, down about another 100 pips, because that comes at 79.50. We're trading at 80.93 right now, so about 140 pips from where we are now is the exact 61% retracement off the 2009 low. Also, Rob, it's a butterfly pattern. A 3-drive pattern that's forming on the long-term weeklies. So what I have to do here is I gave it a try at the 81.20 level, and I lost my 30 pips there, and I will wait now to see if it can get 140 pips from where it is now. The way these markets are jumping overnight, the euro moved 150 pips down very, very quickly last night. The pound was down a couple hundred. So these markets are moving very, very volatile, which you love to see, but you have to wait for your prices to come in. And so I think that that's what you have to do, is wait for that breaking of the 80 level in the Australian dollar and then take a look at it.
Okay, so 79.50 is the...
That's the 61% retracement, right? Yeah, of the long term going back to October of 2008. We went from 60 all the way up to 110, which was about a 50% move. And, more than that, almost double the move. And then the 61% retracement on that does come in at 79.50. So, and we're only 140 pips away, which would be like one more day like we had Friday or today, and we would be there. So just be patient and see that it gets to that spot.
Is this tied to the euro in any way? Like if they are tied to the euro, but the dollar index is the key there, because the euro is 53% weighted to the dollar index. But if you take the major cross rates, the yen, the pound, the Canadian, the Australian, the Swiss, if you add those all together, that's about 90% of the U.S. dollar index. But 53% of it is the euro. So that's the key. I mean, nothing trades more than the euro. It trades trillions of dollars every day, as opposed to just a few hundred million in stocks. So it's much, much larger than anything else. And that's what's causing all of these, causing all this volatility in the stock market, is the currency markets. Because when you have the German Bund going negative, I mean, stop and think about that. If you're a hedge fund manager or a bank or something, and you've got negative interest rates staring at you, you're there to make a return. What are you going to do? You got to search for another vehicle to put your money. So what do? They bring it into the Treasury bond market here, because we're still yielding, right near 3%. So that's a heck of a move, and it's AAA rated. So, you stop and think, 0 versus 3%, something's not right with this picture, Rob. I don't know what it is, but there's something not right. Well, best wishes for a great year. Take care.
Oh, thank you. And then thanks for the kind words, and a happy holidays to you for the rest of the year.
Okay, bye.
All right, Rob. Thanks a lot. Okay, we got just a few minutes here. Remember, folks, we got the full moon today, so we're very close to the 61% retracement in the S&P at 2010. So live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.